Hi, my name is Larry Ewing. I'm a partner with Sikich LLP. My field is state and local taxation. Today we'll be talking about multi-state sales and use tax. First of all, for a business that's been doing, say, business in one state, unless you're fortunate enough to be doing business in one of the few states that does not have a sales and use tax, you're probably filing some sort of sales and use tax already. The question is, has your business expanded, or perhaps is it possible a business may not realize that it has liabilities in other states than what it thought it had, again, for sales and use tax. One of the most important concepts to examine when looking at if you might have potential liabilities in additional states is the concept of nexus. The leading case in this area is a U.S. Supreme Court case that was handed down in 1992. It's called Quill versus North Dakota. In that case, the Supreme Court reasoned that the Commerce Clause required a bright line test for taxpayers to determine when they owed sales and use tax in a given state. And they determined that this bright line test would be physical presence. Now, Quill had no physical presence in North Dakota. What it did, it sent a lot of catalogs into the state. The facts in this case predate the internet. But by sending the catalogs there, they had acquired millions of dollars worth of business, and the state reasoned that there was economic presence in the state. Again, the Supreme Court turned that down in favor of a physical presence bright line test. Now, within the discussion of the case, there is some language, if you read the opinion, about a company purposely availing itself of the benefits of the state's economic market. And some taxpayers have tried to assert that this is a requirement. For instance, there's a case out of Illinois in 2000 called Town Crier. Town Crier is a Wisconsin furniture company. And what it did is it made sales to many Illinois residents, but the Illinois residents went to Wisconsin to make the purchase. Town Crier would then ship in its own trucks the furniture to its Illinois customers. Illinois said, you must register and pay the tax. Town Crier asserted the defense that, but we're not purposely availing ourselves of the Illinois market. We don't send catalogs there, there's no advertising in the state, that sort of thing. This purposely availing a company of a market was a test that the court said it or any other court had not decided was a criterion for determining if sales and use taxes was to be registered, forwarded, and paid. As such, they rejected the argument of Town Crier, and to this day, the primary test for determining if sales and use tax is due to a state is, again, physical presence. Now, what is physical presence? I mean, obviously, I think most manufacturers, companies for that sort, know that if you have a plant, a warehouse, a distribution center, whatever in the state, well, you have Nexus there. And if you don't have retail sales, you're at least going to owe tax on your purchases upon which the vendor hasn't already collected a tax. But a lot of times, companies have physical presence other than just a plant or whatever in a state. One of the most common forms is salespeople traveling around, or salespeople located in other states. A lot of times companies will assert, well, there's a federal protection in this. If all we're doing is soliciting sales in a state, federal law prohibits the states from taxing us. Actually, what companies are referring to is a federal statute called Public Law 86-272. What this states is if a company is purely soliciting sales in their states, there's no these orders are approved from without the state, the orders are filled from without the state. What happens is that state is prohibited from imposing a tax on a taxpayer that's measured by net income. In other words, this is an important nexus concept, but one that does not apply to sales and use tax. In fact, in this case, the presence of salesmen in a state, again, just doing pure solicitation, does create sales and use tax nexus. Often, just a temporary presence will create nexus. A lot of companies, when they're evaluating, do we have nexus in a given state or not, will look to see where their employees are officed out of, or something like that, as opposed to considering where the employees may occasionally travel to in their function of solicitation. One of the better known cases for this was decided in 1995. It was the Orvis Company case, and it was a New York case. In this case, Orvis made about 41 trips over a period of 3 years into the state of New York to help customers, this sort of thing. The court reasoned that this was part of their business function. It was actually rather cyclical, and as such, it also created Nexus for the company within the state of New York. This case has been cited by many other cases in other states. Another thing is delivery in one's own trucks can create Nexus. By this kind of delivery, we're not talking by UPS or another common carrier. It's in the company's own trucks. Again, we had the Town Crier case we recently spoke about, and there's also probably a better known case, again out of Illinois. It's handed down in 1996 called Brown's Furniture, Inc. versus Raymond Wagner. In this case, the furniture company in Missouri made 941 deliveries in 10 months to Illinois residents. And the Illinois court held this was certainly enough to establish Nexus within the state of Illinois. This case, by the way, has been actually cited in many other cases of other states. Now, it's interesting to note that, when you're considering what's physical property within a state and what's employees in the state, just a couple of comments on this. First of all, the property does not have to be within the control or possession of the taxpayer. For instance, many companies might have inventory and consignment in other states, but they still retain title to it. Similarly, sometimes manufacturers will contract out certain manufacturing and will leave tools, dies, jigs, that sort of thing at the subcontractor manufacturers for their use in making materials for them. All these sort of things, if title is retained to it, it's still the property of the taxpayer and can create Nexus for the taxpayer. In the same way, it's not just employees, or property for that matter, that can create Nexus, but also contracted parties as well. Probably the most common form of this is manufacturers' representatives. These are contracted sales representatives that many manufacturers use, especially in areas of the country in which they don't already have employed salesmen. There are two leading U.S. Supreme Court cases on this very issue. Scripto Inc. versus Carson, it's a 1960 case, and also the 1987 case of Tyler Pipe Industries. And both of these, again, said what was important here was not if it was an employee or a contracted individual, rather that what was being done was a business function of the company. A lot of the things changed around the 1990s when we saw the rise of the internet. Many companies had a traditional distribution sales infrastructure, if you would, using salesmen, contracted manufacturers, rep, distributors, what have you, and often had sales in Nexus all around the country, often in multiple states. But they did not have retail sales, and since sales and use taxes only tax sales if they're at retail, there was no liability to worry about and report. However, with the advent of the internet, many companies set up a website and would make sales at retail. These would be in addition to their normal sales. The problem is suddenly you had Nexus in multiple states combined with retail sales, creating a liability. Many companies were not aware of this for a number of years until suddenly they're audited by state. Many companies, when they became aware of this problem, or if they had been advised by a professional beforehand, set up separate companies to incorporate the internet company into. The problem was often the internet company would refer business to the regular company and vice versa. And this created, in many states, affiliate nexus, or certainly arguments of affiliate nexus. This has become a growing problem, and the states have become more successful with these sort of arguments. So separate incorporation of the internet website may be not enough to separate, if you would, the nexus creating activities of the main company from the retail sales of the internet company. Now, in addition, Through the years, there has now, more recently, within the last few years, we've seen the rise of what are called click-through Nexus laws, or they're also called Amazon Nexus. This started in New York and can probably be best illustrated by an example. Assume that I'm a manufacturer of camping stoves. My marketing people come to me and say, you know, in New York, there's this well-known manufacturer of tents, and we think we can strike an agreement with them so that somebody can go to their website, click on a button, and be transferred to our website where they can then buy our camping stoves. Let's assume we go ahead with this deal. What happens? We have the New York company, their website. New York residents click on that website, are transferred to our website where we make the sale, and then pay a commission to the New York company. Sounds like a win-win for everybody, but under a New York law, I may just have created a New York tax liability that I have to collect from my New York purchasers and remit to New York, even though I may have no physical presence at all in that state. The argument for the states is, or the reasoning is, that the other party, the New York company, acts as my agent. I probably feel it's just a form of advertising. However, through the case of Overstock.com, of which Amazon was also a party, New York has said, or rather their courts have said, this type of law is constitutional, it's allowed, and New York has the authority to impose this on taxpayers. About half the states have adopted similar laws, either require reporting or the collection of tax, such as the New York law. One of them was Illinois. Illinois recently had a Supreme Court opinion handed down in October last year that didn't address the constitutionality of the Illinois tax, but it did say that it violated the Internet Tax Freedom Act. So until the Illinois statute is changed, or as long as the Federal Internet Tax Freedom Act is in effect and not expired, Illinois is not going to impose this sort of tax. Another question is, what is the taxable base? Assuming that you have Nexus, you've gone through all the Nexus determinations, you have Nexus in a state, you have retail sales in a state, what's the taxable basis for any sales? Well, this varies from state to state, and often the state in its statutes will have what's included in the tax base, what the tax applies to. One of the most common items to address in this is shipping and handling charges. This varies greatly from state to state. In fact, recently, the Illinois Department of Revenue tried to change the Illinois law on this. Other states have varying laws on this too. So as you move into other states, comply with other states, that's something that has to be considered. Also, there are varying exemptions in other states' tax. Exemptions are transactions that are excluded from taxation within a state. For instance, all states have a resale exemption. In other words, I'm selling an item to another manufacturer that they either incorporate into their product and sell, or perhaps I'm selling it to somebody who's then going to resell it to another party. Again, resales are always exempt from taxation, no matter what state you're doing in, although they may not call a resale exemption. So if everything I sell is for resale, it's important to know where I have Nexus, but until my business model changes, probably don't have any sort of liability. 34 states, at least the last time I checked, actually have exempt manufacturing machinery and equipment. Now the advice of this is, or rather the importance of this, is many manufacturers sell to other manufacturers, drill presses, all sorts of equipment, milling machinery. But the point is, in many states, this sort of thing is exempt from taxation. It's not a resale, but it is exempt, however. And lastly, another large area of exemptions is that the customer you're selling to, the organization itself, may be exempt from tax under their state laws. For instance, perhaps you sell testing, gauges, that sort of things that are often used in research and development. Now, depending on the state, that may or may not be considered exempt under a manufacturing machinery exemption. However, if you're selling to a school, let's say an exempt university, for purposes of what they do in their instruction and teaching, this may, depending on state law, or that party may, under state law, be exempt, and the transaction may be exempt. Now, there's an old saying, every sale is taxable unless you have the certificate or other documentation proving that it's exempt. So that is upon audit the stance auditors will take as they come in from states. Show me the documentation. Show me the certificate. If you don't have it, it's taxable. So for that reason, I recommend always get the appropriate certificate to document an exempt sale. And in addition to this, I would also recommend gathering those not just for the states you do file in, but maybe the ones you don't as well. The problem might be is you might have a salesman who's gone into a state, goes there several times a year, creates Nexus, and your tax function isn't aware of it. Accordingly, they haven't registered or collected taxes in that state. Some auditor might come in the future, might go through the expense reports of your employees and see where this employee has been in the state. Or one of your customers, when investigated by the state, might say, well, yes, they have a person who travels here from time to time and makes sales. In any event, several years down the road, if you need the exemption certificates, your chances of obtaining them are not only slim, but may be very difficult. For instance, you may have customers who have since gone out of business. Another area where documentation is key, but also problematic, is in the area of drop shipments. This is where I have a customer who buys from me and then resells the product. They tell me to ship to their customer, not to themselves. The problem is in the state where the ultimate customer is, my customer, the retailer, may not have Nexus, and he may not have may not be registered in that state. He may not have to. So what happens is, I deliver to that state. He has given me a resale certificate for the state he does do business in, but the state I've delivered to said, sorry, we only accept our state's resale exemption. This can cause headaches for me and potential liability. I mentioned that there are cases occasionally where a company finds out, gee, we didn't know we had a liability in a state. This may be due to the internet sales I mentioned before. It may be due, as I mentioned before, a salesperson or say a manufacturer's rep that's been regularly going into a state and nobody was aware of it. So suddenly liabilities occur and we might find out that we have 8-10 years past liabilities. How do you address that? Many companies, by the way, are very concerned about this, especially when sale of the company is being considered and they know they will have to go through a due diligence process and these liabilities might be found. In addition, they might be aware that some of their competitors are being audited by these states and they may be next on the list. What can you do about it? Well, you can't totally eliminate all the liability, but there is available in almost all states a concept known as a voluntary disclosure agreement. Under these agreements, which are usually established first on an anonymous basis using either an attorney or a CPA, you'll agree with the state that going into the future, you will comply with their laws, you'll collect the taxes as needed, but the state will agree that they'll only go back typically 3 or 4 years. So all the years you might have been in there before then and all the liabilities related to those early years will be forgiven. You pay the taxes for the agreed upon number of years, in my example 3 or 4 years, and you also pay the interest. However, the penalties, both civil and criminal, are eliminated. And keep in mind, often these cases are criminal penalties. Most likely, if they are assessed, they'll be upon the officers of the corporation. The one catch to this, however, is if the company is already under audit or has received an audit notice from the state. In some cases, even a certain type of notice from the state other than an audit notice will also preclude a voluntary disclosure. So this can be a great device to eliminate a lot of past liabilities. One many companies may want to consider going this route, but it's best to do so as soon as you can before you receive any notices or communication from the subject state. Finally, some last thoughts. Keep in mind that many states have an overall state rate for products, but they also may have local rates. Sometimes these are administered by the state's Department of Revenue. Sometimes these are separately administered by the municipalities or counties that have imposed them. In addition, many states have different rules about, we call sourcing rules, about what municipality within their borders gets to impose such a tax. Many states, again, that have individual rules might be Ohio, Texas. Illinois has a lot of local rates. It's interesting to note that these can change from time to time. For instance, due to an Illinois Supreme Court case they handed down in November, the Illinois current method of sourcing to the municipalities may very well change. We won't know for a couple weeks until our Illinois Department of Revenue comes out with new regulations. There's some other concerns too to consider when you consider registration or a voluntary disclosure agreement with other states. States often have taxes other than just sales and use or potentially income taxes. For instance, in Washington we have a business and occupation tax. Ohio has its commercial activity taxes, and there are a lot of other unusual gross receipts or franchise taxes throughout the United States that the individual states have. So when you consider going into one of these states, registering, doing the agreement, whatever, you may want to look at the state's overall tax structure. Are there other states with similar nexus, or rather are there other taxes in the states with similar nexus criterion to the sales and use taxes? If so, you may want to evaluate those as well and see if your company may be subject to them. You don't want to solve the sales and use tax problem only to find out later on you have another problem with another tax in the state. You want to solve all the problems at the same time. I hope that my presentation today has been of value to you, may have raised some questions for you or some issues you want to address. It's been a pleasure speaking with you, and thank you for the opportunity to view me today.